Hey everyone, welcome to this explainer. Have you ever stared at the stock market and just felt totally overwhelmed? You see the sheer volume of choices, those crazy complex charts, and literally a million people giving conflicting advice online? Well, you are absolutely not alone. Today, we're going to strip away all of that noise. We're focusing on a shockingly simple, almost quote-unquote boring, but incredibly effective wealth-building strategy, the simple three-fund portfolio. Because let's be real, investing your money shouldn't feel like you're trying to defuse a bomb. Let's get right into it.
Here's our roadmap for today. We'll cover the beginner investing trap, the tax-free secret, the three-fund portfolio, finding your perfect split, and finally, when should you sell?
All right, starting things off with Section 1, the beginner investing trap.
So the very first hurdle most people hit is just the pure paralysis of choosing an investing platform. And because it's so confusing, it is super easy to fall into the high-stress trap of day trading. Did you know that 80 to 90% of day traders actually lose money?
Yeah, no thanks.
To cut through the noise, just use this really simple platform checklist. The absolute non-negotiable must-have is FCS protection. If a platform is not covered by the Financial Services Compensation Scheme, you need to walk away. This protects your money up to £120,000 if the platform itself actually goes bust. Beyond that, you're looking for low fees, access to tax-advantaged accounts, and honestly, an interface that's just easy to use. Don't make this harder than it needs to be.
Moving right along to Section 2, the tax-free secret. Okay, choosing the wrong account type is just as bad as picking the wrong investment. Getting this wrong could literally cost you thousands of pounds in unnecessary taxes over your lifetime. Look at the general investment account here. With this, you're paying 10 to 20% in capital gains tax just on your profits. Ouch. But then check out the Stocks and Shares ISA. This account legally and completely shields your profits from taxes. Now yes, there's a limit, but it's wildly misunderstood. That £20,000 limit, that only applies to what you deposit inside a single tax year. It does not cap your total balance. You could theoretically grow that portfolio to over £1 million, and every single penny of those profits remains totally tax-free. It's a total game changer.
Section 3, the three-fund portfolio.
This is the core strategy, a low-stress method famously championed by the Bogleheads community. But before we build it, we kind of need to demystify some of the jargon, like what actually is an index fund? Well, think of it like this. Buying an index fund is basically just buying a giant basket that already holds small pieces of hundreds or even thousands of top companies. Instead of trying to pick one single winning stock and risking your shirt if you get it wrong, you just buy the whole basket. It is so much less stressful than dropping all your eggs into one bad stock pick.
And here's the best part. You literally only need 3 of these baskets to build a globally diversified portfolio. First, you get a U.S. stock index, like the S&P 500. This gives you ownership in America's top companies, the absolute giants for growth. Second, an international stock index. This spreads your money across businesses outside the U.S. for massive global reach. And third, a bond fund. This is essentially you lending money to governments for a steady, reliable return. It acts like an anchor, adding critical stability to smooth out the stock market's inevitable roller coaster ride.
Section 4, finding your perfect split.
Now, investing is definitely not a one-size-fits-all thing. How you split your money depends entirely on your age and your risk tolerance. Take this young moderate portfolio, for example. If you've got decades ahead of you before retirement, you can afford to take some calculated risks. So you'd heavily weight your investments towards stocks for that massive long-term growth, 55% in U.S. stocks and 35% in international stocks. But being moderate, you still keep a small 10% cushion in bonds, just to soften the blow if the market takes a temporary dip.
Now compare that to an older investor who allocates a massive 40% to bonds. They're getting closer to retirement, so they really want to protect the wealth they've already built up. Middle-aged investors tend to balance it out a bit more evenly. But check out the young, aggressive profile on the far right. They skip bonds entirely. No way, right? Why? Well, because historically, if a market crashes, younger people have the time to just wait it out and recover even stronger. Honestly, playing it too safe when you have a ton of time on your side is often the bigger risk.
I know a lot of beginners freeze up right here because they're thinking, look, I don't have thousands of dollars to buy full shares of all these huge funds. Well, guess what? You don't need to. Enter fractional shares. This lets you buy tiny slices of these funds. You just invest whatever specific cash amount you have, whether that's £100 or literally just £10, and you own a corresponding percentage of a share. It's that easy.
And the actual mechanics of buying? Stunningly simple. Step 1, you search the ticker symbol of the fund on your app. Step 2, choose market order. You're going to see fancy terms in the app like limit or stop orders, but for a long-term passive investor, a basic market order is all you need. It gets the job done instantly at the current price. Step 3, select value instead of shares so you can type in the exact cash amount you want to drop in. Hit buy, and boom, you're officially an investor.
All right, our final section, Section 5. When should you sell?
You know, holding a stock for the wrong reasons is just as dangerous as buying the wrong one in the first place. You've got to have an exit strategy so you aren't driven by panic or greed. Before you even think about hitting that sell button, you absolutely must understand what drives the price of an asset. There are 3 types of stock value. First is fundamental value. This is what we long-term investors care about. Actual revenue, real assets, real profits. Second is trading value, which relies on short-term technical chart patterns. But the third one, momentum value. This is the most dangerous. It's driven entirely by internet hype, trends, and raw emotion. That price is incredibly fragile.
Which brings us to the first highly logical reason to sell. The momentum is dying. If you notice an investment you hold has skyrocketed simply because everybody on the internet is suddenly talking about it, you need to recognize that hype always fades. And when that popularity inevitably dies, the stock price usually collapses right along with it. That is the exact moment to sell a portion and lock in your profits before reality sets back in.
The second reason to sell actually has nothing to do with the stock market. It's about you. You should sell if you need the capital for a bigger, better opportunity. Sometimes the smartest possible move is reallocating your money into something you actually control with even higher potential. Like maybe securing a great real estate deal or funding your very own startup business. Please don't let your money sit blindly in the stock market if it could be changing your life right now in the real world.
And the third valid reason to sell, the market has fundamentally shifted against the investment. If a company you own is suddenly losing ground to disruptive competitors, has terrible management, or its whole business model is becoming totally obsolete, think printed newspapers when smartphones came out, get out. Loyalty to a dying business model is only going to cost you money. The market absolutely does not care if you own the stock.
However, if the fundamentals haven't changed and you are consistently investing in a broad 3-fund portfolio, this quote right here is your absolute golden rule. Time in the market beats timing the market. True, compounding wealth does not care about your daily motivation or your emotional panics. It only responds to consistency. If you invest steadily, say just £250 a month for 20 years, historical data shows your money could multiply dramatically simply by leaving it alone. The big winners aren't the people trying to outsmart everyone else, they're the ones who just stay invested, year after year.
So as we wrap up this explainer, I want to leave you with one final, vital question. Will you trust a simple, quote-unquote, boring system long enough for time to work in your favor? Building incredible wealth doesn't require high-stress day trading. It just takes a protected platform, a tax-free account, a disciplined 3-fund split, and the patience to let compounding do all the heavy lifting. Resist the hype, avoid the panic, and maybe it's time to take that first step. Thanks so much for joining me today, and I'll catch you next time.